Alrighty guys, sorry for being a little late. We got some sickiness in the house and it's just a crazy world. I can give you guys some tips on brisket if you like. I've been doing it many years now at this point, so I can probably help. Let me put airplane mode on that phone. There we go. Did you guys figure out what we're mining with? Honda Land said 3050. There you go. What are we mining? All right. Good to see everybody here. Hope everybody's having a good day. Good morning and welcome everybody to the Crypto Mining Show, your one-stop shop for all cryptocurrency news from the perspective of a cryptocurrency miner. I go by Blind Run on the internet and Matthew in real life. Today we're going to be talking about the Ethereum testnet merge and how it's mostly successful. We probably have, of course, one more step here with the merge of the testnet closer to the actual merge on mainnet, or at least that's what you would like to see if you are hoping for the ETH price to be maintained. We're also going to be talking about DeFi and how it suffers from centralization and some possibilities of correcting that. Of course, that is going to tie into Celsius and their freeing up of some collateral. We also have Argo blockchain hiring derivatives trader to navigate the market. And they're selling some Bitcoin as well to reduce loans. Everybody is selling Bitcoin to reduce loans. Ooh-wee. I mean, kind of according to plan. ETH is pumping, by the way, up to 1,200, over 1,200, which is pretty cool. But we're also going to be talking about Immutable X and its Ether to dollar direct withdrawals, which is going to tie into GameStop. And there is a question being posed of, is GameStop worth more than MetaMask and OpenSea combined? Primarily due to the fact that they are going to be utilizing Immutable X and setting up their own NFT system. Then we have some hardware news. As always, we have AMD, NVIDIA, and Intel advanced chips easily available to the Chinese army. What is going on there? AMD's president talks about GPU efficiency, so we're going to get some more information on that and their chiplet designs, as well as how cash is affecting the GPU market. And then we have a new EIP for Ergo, EIP 31, which is labeled Babel fees. And obviously that is a play on, the word Babel. I like to go back to like the Tower of Babel from the Bible. If you guys aren't familiar with that story, just think of it as, an idea of bringing a whole bunch of things together, whole bunch of parts to create a whole. The idea would be obviously the Tower of Babel. Everybody spoke the same language and they would be able to accomplish anything, including, building a tower to the heavens. Let's get into it right after a word from today's sponsor. Today's video is brought to you in partnership with GamerSupps. GamerSupps provides a healthy alternative to sugary energy drinks with delicious flavors like Misfits Melon or my favorite. Today's sponsor is Crypto.com. Go check out Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs quickly while earning up to 8% cash back. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. And welcome back, everybody. So I did notice in the interview yesterday with the the community manager for the Solus Citadel NFT on Zilliqa that I was breathing into the mic a lot. So I'm going to try to solve that and not do that as much when we're doing these interviews. It's a little difficult sometimes when you're just trying to get content out, especially content like that, to keep it going, but I apologize for that. That being said, first things first, today we're going to talk about EIP 31 and Babel fees. So this was committed on, I believe, January 25th. This is something that Ergo has been talking about recently, as well as the Nautilus wallet. And I thought that it was very important to talk about because it is very unique in the DeFi world, or basically in the blockchain world in general, not dissimilar to pretty much everything that we talk about surrounding Ergo. And the term Babel fees refers to the concept of paying transaction fees in tokens. So, i.e., for example, stable coins like SIG-USD instead of a platform's primary token like Ergo. So if you were on, something like Uniswap, even on Ethereum, if you're more familiar with that and not familiar with Ergo Dex, which I think you should start getting familiar with Ergo Dex, by the way, because of this. But if you're familiar with something like Uniswap, what you have essentially is you go in and you swap a token for another token, right? Decentralized finance. When you do this, though, you pay fees on that network, and you pay fees in that network's native token. So for Ethereum on Uniswap, you pay it in ETH, right? And on, of course, Ergo Dex, which is what we're talking about here, you pay it with ERG. What they are proposing to do is to allow you to pay for fees on the Ergo network with other tokens that you have in your wallet. And this is actually quite revolutionary, in my humble opinion, for DeFi, because it will also help make everything a lot more simple for the end user. I know a lot of people will be like, oh, I just tried to swap and now I don't have any ERG because I fully swapped all of my Ergo for Neta, and now I have 0 Ergo in my, or ERG in my wallet, and now I got to go get a faucet or get somebody to send me ERG, which, yes, I know I've done that for at least a couple of y'all here on this channel when you've run out of it because you missed that point. So end user, like UX, like end user experience, that sort of thing, awesome change here in my humble opinion. So let's get into it a little bit more. For more information about the origin of the term Babel fees, please refer to the following link. But EIP 28 aims to provide the standard for paying fees in tokens, and thus has the same goal as Cardano's Babel fees. However, it chooses a different approach, with the main difference being that EIP 28 does not require any type of forking. With Cardano's approach, users publish invalid transaction and has to wait, hoping that somebody will take his tokens and pay the transaction fees in a primary token, ADA, therefore completing the transaction. EIP 28, on the other hand, chooses the opposite approach. Supporters who wish to make money out of the EIP 28 will publish UTXOs containing primary tokens locked by smart contract. These will contain price attribute, i.e. how much of the primary token is that one specific supporter willing to pay for one piece of user's token. For example, the stable coins. Let's call the user's token a Babel token. User who is willing to pay the transaction fees in Babel tokens can now find whether there exists any UTXOs belonging to the P2S address, specifically by corresponding smart contract for that specific Babel token. If there is any UTXO which contains enough primary tokens for required fees, the user can calculate the price of buying the required amount of primary tokens from this UTXO and then decide whether or not he wishes to use it. In case he accepts this exchange ratio defined by the UTXO's price attribute, he can consequently spend this UTXO in his transaction to cover the transaction fees. This spending user now has to recreate the UTXO with the same parameters and insert the required amount of Babel tokens into it. Primary tokens difference should be less or equal to the inserted Babel token amount times price, which is going to be ensured by the smart contract. Strong advantage of this approach compared to Cardano's one is that user always knows in advance whether there is an opportunity to pay via Babel fees or not. And if there is, what is the exchange ratio? He can therefore be almost certain that if he decides to use it, his transactions will be included in the blockchain ledger. Be aware, however, that there exists some exceptions to this rule, which is later discussed in the wallet's implementation section. What's the motivation? Many users use blockchain solely for transferring native tokens such as stablecoins or even meme coins. These users understandably do not want to be bothered with keeping an eye on the amount of blockchain's primary token they own or even obtaining this primary token in the first place. We did talk about that, right? Once they run out of the primary token, they have to difficultly and often costly swap their tokens off or of interest for the primary token that they can later use to cover transaction fees. Since primary tokens are also needed for these swaps, users may be forced to introduce new capital to their portfolio solely for the purpose of purchasing primary tokens used for fee paying. Since basic transactional fees on the Ergo blockchain are generally quite low, the Babel fees users would be probably willing to pay a fee that could be higher than that of the primary token transaction in exchange for being able to pay in their token of interest and not having to bother with the blockchain's primary token purchase. This brings up a financial incentive for EIP28 supporters who could benefit out of this arbitrage by providing the liquidity for such Babel fees users, with primary token selling price expressed in tokens of interest being higher compared to the same token pair on the exchanges. And so the rest of it's pretty much code. I think that this is super awesome just personally. Obviously, there is a version of this coming to Cardano, but this is basically the next level to that, right? So just wanted to bring that up, show you guys what's happening in the DeFi space. These are the types of things I'm always interested in seeing, like these small little steps in evolution of each individual blockchain and their ecosystem. Now, one of the thoughts I had that would be extremely interesting is how this could apply to Flux, actually. So I know we're talking about ERG here, but with Flux, you essentially have like a swapping mechanism within the ZIL Core wallet. However, one of the hard parts about that within Flux is that you end up like having a whole bunch of different chain fees that happen. So a Babel fee system that could be cross-chain would be probably the most ideal setup here for Flux. Now, I don't know how you get to that point with Flux, but that is kind of one of the ideas I had. And this was, came into my kind of thought process because of the liquidation of Flux with, of course, crypto.com right now. You can watch my video on how to do that. But as you may or may not know, if you do send your Flux to crypto.com, you can deposit, but only via the Binance Smart Chain wrapped Flux, which means within the ZIL Core wallet, you have to go in and you have to swap your Flux for Binance or BSC or, wrapped Flux. And what that means is that then you have to have a little bit of Binance or BNB also within your Flux wallet to be able to do that process. And that can be very cumbersome and confusing and annoying, especially when you have a wallet like ZIL Core that frankly is super awesome, has a lot of utility, but has just so much utility that it can get quite confusing quite quickly, because then if you swapped, your Flux for Ethereum wrapped Flux, then you need a little bit of Ethereum to then swap it back. And then if you had, whatever it may be, right? Choose the platform, KDA wrapped Flux or whatever it may be, whatever that parallel asset is, it can be extremely stressful. So a cross-chain version of Babel fees is really where I see the industry going in the future. This is obviously going to be way out, and where we're starting at with Ergo and Cardano here is the right way, the right path. This is the way, and I think it's going to be super awesome for DeFi in general. Will, Ethereum adopt this? Let's see if they can get past the merge, right? And then we'll see if they adopt anything similar. I would expect a layer 2 solution for Ethereum to do this first, right? So something like Polygon before Ethereum themselves actually ever got to it. AMD's president talks GPU efficiency, power targets, chiplets, cache, and how NVIDIA and Intel stack up to them, says Raja Kaduri. in and says Raja Koduri is a visionary. There we go. AMD's senior vice president, Sam Navziger, that's what we're going to go with today, had a lot to talk about regarding GPU efficiency, power numbers, chiplets, cache, and how their competitors stack up to them in an interview with VentureBeat. Sam has been at AMD for 16 years and currently has the role of Senior Vice President, Corporate Fellow, and Product Technology Architect at the Red Camp. One of the key areas where Sam has focused is the Power Efficiency and Power Technology Department. A few years ago, AMD laid out an ambitious goal of hitting 25 times performance efficiency by 2020. And the company actually achieved it. Currently, AMD-powered supercomputers not only land in the top 500, but also on the green 500 list. Now, the company is taking things further, achieving a 30x efficiency growth by 2025, or just 3 years from now. I would like to point out, too, we had a huge pump due to this in AMD stock just today, as I was driving back from getting a coffee, because I didn't make coffee today because I'm an idiot and forgot. So I wasted money on a coffee, but we'll get there. Considering all of the techs that AMD has coming soon, we are really excited to see AMD hitting this goal. During the interview, Sam talked about some of the key ways how they are achieving these goals and how the competition compares to them. It is no longer a mystery that next-gen GPUs are going to get more power hungry. AMD recently confirmed this themselves, and we have several NVIDIA leaks confirming the same thing. In a slide presented by AMD, the company expects GPUs to hit over 600-watt TDP figures. You can see here, holy moly, as we get closer to 2025, even before 2025. The company states that power consumption is exploding since demand is outstripping the gains. To address this, AMD has a few key technologies up its sleeves that will allow them to ship a GPU that's compelling in both performance and wattage versus the competition. We've driven the frequency up, and that is something unique to AMD. Our GPU frequencies are 2.5 gigahertz plus now, and that's on the 6000 series, by the way, which is hitting levels not before achieved. It's not that the process technology is that much faster. And that is something that I did notice, right? We got our confirmation on Ada Lovelace from NVIDIA yesterday on their core clock, only going up to like 2520. And I think max boost, like game boost, where it can hit for a little bit and come back down, was only 2700 megahertz. When the rumors, right? First of all, what AMD already has on the 6000 series is 2700, right? And rumors of, cracking that 3 gigahertz. However, they're still on 5 nanometer, and NVIDIA is even utilizing a custom process to get from 5 nanometer to 4 nanometer. However, they're not even hitting the same core clock. So it is clear that it is not a process technology. So they say, but we've systematically gone through the design, re-architected the critical paths at a low level, the things that get in the way of a high frequency, and done that in a power efficient way. Frequency tends to have a reputation of resulting in high power. But in reality, if it's done right, and we just re-architect the paths to reduce the levels of logic required without adding a bunch of huge gates and extra pipe stages and such, we can get the work done faster. If you know what drives power consumption in silicon processors, it's voltage. That's a quadratic effect on power. To hit 2.5 gigahertz, NVIDIA could do that. And in fact, they do it with overclocked parts, but that drives the voltage up to very high levels, 1.2 or 1.3 volts. That's a squared impact on power, whereas we achieve those high frequencies at modest voltages and do so much more efficiently. We analyze our design pre-silicon as we're in the process of developing it to access that efficiency. We absolutely analyzed heavily the NVIDIA designs and what they're doing, and of course targeted doing much better. If we can already see that in RDNA 2, which hits over 2.5 gigahertz clock speeds while retaining a lower wattage than its direct competitor from NVIDIA. Sam highlights that the high power levels come directly from voltage. He states that NVIDIA GPUs can achieve the same clock speeds and even hit those in custom variants, but to do so, they have to drive voltages up. We just read all that. He does go on to say that the Infinity Cash in particular was an exciting thing to bring to the market. And like I've talked about before, as we're seeing NVIDIA fall in line with the whole new re-architected idea of adding more L2 cache, obviously Infinity Cache is a threat to NVIDIA. And so I do believe them that this is a big deal. That, as well as some of the power optimizations, was a CPU leverage capability. At the core of that is the same dense SRAM array that we use in our CPU designs for the L3 cache. It's very power efficient, very high bandwidth, and it turned out it was a great fit for graphics. No one had done such a large last level cache like that. In fact, there was a lot of uncertainty as to whether the rates would be high enough to justify it. But we placed a bet because going to a much wider GDDR6 interface is certainly a high power solution for getting that bandwidth. Once again, I talk about this in relation to cryptocurrency and mining because I think there's untapped potential in either the way that the algorithms for the mining process are developed or on the miner end developing and actually leveraging and taking advantage of Infinity Cache in some way or another, because this will have to be the path forward to reduce the power consumption from the memory modules. And that's what he's highlighting here. We placed a bet on that. We went with a narrower bus interface, oh, we're aware, and a large cache. That's worked well for us. We see NVIDIA now following suit with larger last level caches, but no one's yet at 128 megabytes yet. Well, NVIDIA's not, right? AMD will be. We're pretty aware of that. And on the NVIDIA side, we're seeing 96 megabytes of L2 cache coming here soon, right? On Ada Lovelace. So what they did is basically we're seeing a revolution, a revolutionary change to the way graphics processing is talked about and developed, right? We're moving into this kind of new last level cache realm to improve, at least your traditional rasterization. He goes on to say it's hard. So VentureBeat asked, compared to NVIDIA and Intel, do you feel like we're in a state divergence when it comes to designs or some kind of convergence? I think we're in a convergence, right? Because we're seeing NVIDIA follow suit. I think they're just too far behind. That's how I see it, right? It's hard to speculate. NVIDIA certainly hasn't jumped on the chiplet bandwagon yet. We have a big lead there and we see big opportunities with that. That they'll be forced to do so. We'll see when they deploy it. Intel certainly has jumped on that, and Ponte Vecchio is the poster child for chiplet extremes. I would say that there's more convergence than divergence, me too, but the companies that innovate in the right space the soonest gain an advantage. Yep, that first mover advantage. It's when you deliver the new technology as much as what the technology is. Whoever is first with the innovation has the advantage. Bingo. So they say, he goes on to say, Raja is a visionary. He paints a great and compelling picture of the gaming future and features that are required to drive the gaming experience to the next level. He's great at that. As far as hands-on silicon execution, his background is in software. He definitely helped AMD improve our software game and feature sets. I worked closely with Raja, but I didn't join the graphics group until after he had left. He had a sabbatical there and went to Intel. So as far as the performance per watt, that was not really Raja's footprint, but some of the software dimensions and such. And as we know, really, if we want to be completely honest, the graphics department under Raja, even the software, especially the software, wasn't that good. And he's the one that's working on the Intel GPUs. Look, there could be other things going on at the company that affect that and so on and so forth. But from the Raja time at Radeon compared to the time at Radeon now, it's night and day in performance and software, right? So I don't like, from that aspect and from kind of the rocky releases of the Intel GPUs in the early reports, I have very little faith in Intel really doing much of anything. That being said, it really doesn't matter because China really wants those parts, specifically the Chinese army. AMD, NVIDIA, and Intel's advanced chips easily available to the Chinese army, warns a report. Why are they doing this, right? Chips designed and sold by several large U.S. companies are making their way to the Chinese military, outlined a new research report from the Georgetown University Center for Security and Emerging Technology, CSET. The report, which was published last month, uses publicly sourced purchase records from the People's Liberation Army, PLA, to outline that processors and graphics processing units from Intel Corporation, NVIDIA Corporation, and Advanced Micro Devices might have made their way to the Chinese army to be used for advanced purposes such as artificial intelligence. Get them tinfoil hats on, boys. The report uses more than 20,000 contracts from 2020 to narrow down 11 that saw these semiconductors being bought by the PLA through contractors that were not sanctioned by the United States Department of Commerce. The report starts out by taking a look at 66,321 tenders published by the Chinese military to narrow down 21,088 that sought supplies of equipment, including technology products. These were then scanned for several keywords mentioning processors, GPUs, microprocessors, and others to narrow down the contracts that would have helped the PLA in building its AI capabilities. This keyword analysis significantly narrowed down the scope of the research and led to 323 contracts, out of which 24 explicitly mentioned advanced products, GPUs, ASICs, and FPGAs. Is the Chinese army mining cryptocurrency? Is that what's really going on here? Or is it also AI? Or is it just AI? CSET goes on to caution that the actual number of orders placed by the PLA could be significantly higher since its research is limited only to declassified records. It outlines that during the same time period from March to December 2020, the PLA had also awarded close to 2,000 classified contracts, and any of these would be related to AI products. Additionally, the report admits that there was no way to determine whether the products did make their way to the PLA, but mentions that the suppliers in the contracts are fully capable of delivering them. And basically, you do have some quantities here, like the Titan 5, 10 of them, and the Jetson TX1, 4 of them. And these are essentially all probably being used for AI research by the PLA, which is specifically the Chinese army. The 11 contracts each listed a specific product from either Intel, NVIDIA, or AMD, and most of them also specified the number of units requested. NVIDIA and Xilinx, now AMD, accounted for a majority of these, which is unsurprising since GPUs and FPGAs are widely used for AI purposes. One also requested 4 processors from Intel, and some did not lay out the precise nature of the products. The U.S. government, through its Commerce Department, actively tracks down and sanctions entities that it believes are working with the Chinese military to provide the latter with advanced American origin products that can be used against the national security interests of the United States. On this front, the CSET digs a bit deeper to discover that the intermediaries supplying the PLA with the equipment were not part of entities sanctioned by Commerce. One intermediary, and I can't pronounce that, Sit and Holy, something like that, Limited, is in fact an official NVIDIA distributor partner, believes CSET, and the company is also responsible for supplying Chinese universities with AI products. Another, the Beijing Hensing Technology Company Limited, appears to be a front company to provide the Chinese government and military with technology products, suggests the CSET. Of course, because every company in China is controlled to some extent by the Chinese government and, of course, by nature and relation, the Chinese military. To bolster its case, the research report states that email addresses for Beijing are also used by dozens of other Beijing-based technology consulting companies. The report concludes by explaining that the U.S. government is constrained in its ability to eliminate Chinese access to advanced technology products since it has to strike a balance between geopolitics and the local industry and national security implications. I think like all of us have been aware of AI and some of the amount of power it presents is astronomical, especially as we keep moving forward in technology. And the first, I mean, honestly, like the first country to really get AI and solve AI to the point to where it can, do some very dangerous things on even just on the web. It will be the country that basically the country that controls AI is the country that will control the world. That is pretty much, I think, a moot point, not a moot point, an important point, not moot. Let me be clear. I don't know why I said moot point. It's a very important point when we're discussing, obviously geopolitics and who you would trust with AI. Would I trust, the American government over the Chinese government? Probably, but not much more, right? I think AI is very dangerous, and it's one of those technologies that will eventually, need to be handled with great care. And I fear that we aren't very good as humans at handling great technologies with great care, especially on their inception. So initially there's some sort of huge blowback or big, devastating event when that comes into play. And can you stop AI once it's been deployed? That's kind of the question. Once it actually gets fully matured and fully deployed, can you really even stop it at that point? We can stop dropping nukes after we use it irresponsibly and realize that we wiped out entire populations and go, well, that was, a lot worse than we expected. But, like with AI, it gets a little creepy. Like I said, tinfoil hat, you throw that on and you go, all right. But more news. Is GameStop worth more than MetaMask and OpenSea combined? Now, GameStop is really interesting because GameStop's been in the news nonstop. They've restructured a ton of stuff. Their stores have restructured the way they function. Primarily, if you go into a GameStop now, yes, they have video games, but they kind of moved into more of like a novelty store surrounding video game culture, which is like one of the big changes they made. And in addition to that, this all came from basically the amount of money they were able to secure thanks to what was the equivalent of being a meme stock for a while in a short squeeze. And we've covered, of course, short squeezes and what they are previously. So I won't go into detail there, but obviously that was big news. I think everybody's aware of Game Stonks and Wall Street Bets, subreddit, etc. And then GameStop decides to get into cryptocurrency, specifically into NFTs. And that is where we end up talking about, what their valuation is going to be. And there's really two parts to this, because what you end up having, like I said earlier, that we're going to, and this is kind of a foreshadowing, is that we are also going to be seeing a lot more ease of access utilizing Immutable X. And that's important because, well, that is what GameStop will be using. Let's get into this. Aristotle believed that the whole is greater than the sum of its parts. If we apply the same logic to GameStop's future valuation, the company is worth well north of 20 billion US dollars and might even be worth as much as 30 billion US dollars. However, the reality is much more nuanced. Before the meme stock mania of 2021, GameStop was traversing a terminal decline trajectory, with foot traffic plummeting and the last vestiges of resistance among hardcore gamers to online downloads eliminated by the pandemic and the attendant social distancing realities. However, the video game retailer's newfound popularity among retail investors allowed it to raise a sizable repository of cash, which it is now enthusiastically plowing into its Web3 initiatives. I don't know about y'all, but I don't really count NFTs as Web3. I consider Web3 as a completely separate thing for the most part from NFTs. I realize that there's integration between the two, but my goal with Web3 would be actually being able to host and that sort of thing on the blockchain, more like what you see with like what Flux is doing, where you have basically a VPS type service, than what I would necessarily think of when I think of like an NFT marketplace and that sort of thing. That's me. So like Web3 is a very confusing term, But as a refresher, GameStop is about to officially launch a dedicated NFT marketplace that is built on Loopring's technology and harnesses the ability of Immutable X, an Ethereum Layer 2 solution to allow for minting and trading of NFTs in a carbon neutral and zero fee environment. In order to attract NFT creators, GameStop has created a $100 million fund that is denominated in Immutable X's IMX tokens. Eventually, GameStop aims to host billions of low-cost in-game digital assets and NFTs, including digital real estate and in-game skins, thereby creating a sizable new source for revenue generation. And this is interesting because GameStop's getting into it, right? And this is like what people consider the metaverse, right? But they're getting in on the ground floor, starting out with the NFTs. I would like to point out that by and large, almost every other video game company, including Microsoft, Steam, Epic, you go down the list, they are anti-NFTs, anti-crypto. This really puts GameStop in a position where they haven't been in probably decades, right? Which is they become a first mover again. So they're kind of taking a bet on the first mover within to metaverse as I see it, right? And that's really important here because that could just blow this out of the water for them. Additionally, GameStop has also launched a browser extension-based digital wallet that would allow users to send, receive, and store cryptocurrencies, ERC20 tokens and Ethereum, as well as NFTs conveniently. Moreover, what might well be what the wallet's star attraction, users can swap different tokens directly within GameStop's digital wallet without the need to offload funds to an exchange. I mean, you can do that in MetaMask, right? And you can do that in 1inch, and you can do that in, there's a lot of other services that allow that, but what they get is that name recognition, and they get to start tying that game portion to the NFT market. And that's really where I think it's important, not so much what you can do with it because that is already available. So for the uninitiated, MetaMask is one of the most popular crypto wallets currently on the market with 30 million monthly active users. Consensus, the company behind MetaMask wallet, was last valued at $7 billion back in March of 2022. On the other hand, OpenSea is the most popular NFT marketplace in the world and was valued at over $13 billion back in January of 2022. Given that GameStop is trying to capture the raison, there we go. I actually don't know this term. Raison d'etre? What does that mean? Reason or justification for existence. There you go. Okay, cool. Learning something new every day. All right. Of both MetaMask and OpenSea, it is hardly a surprise that some investors believe that the video game retailer's market capitalization should now take into account the valuation accorded to MetaMask and OpenSea. However, there are a few lacunas in the line of thinking. First, in light of the ongoing carnage in the wider crypto sphere, both MetaMask and OpenSea would be accorded a much lower valuation if a new funding round takes place today. Second, GameStop's Web3 push is still a bit fuzzy on the edges. For instance, the company has already announced that it eventually seeks to enter a partnership with around a dozen other crypto-focused enterprises. However, apart from Immutable X and Loopring, virtually nothing is known about the rest of the prospective partners. Critically, the success of GameStop's NFT marketplace initiative ultimately boils down to the outcome of its negotiations with major game publishers. And yes, I agree, this is where it really comes in. The same entities who have been on the receiving end of GameStop's used game resale business. Given the uncertainties involved, it is not surprising that the market remains reluctant to incorporate an upside to GameStop's market capitalization at this stage. Why did they bring that up, right? Because GameStop's business model was selling used video games, and that basically hurt the bottom line for a lot of video game developers, because what happened is like you would go and you would purchase a game, then you'd sell it back to GameStop, and then they'd sell that to somebody else, and none of the revenue would go to the developers. So what they're essentially saying is that they don't have a good relationship with developers. And that's important because if we're talking about NFTs and moving into Web3, well, what are we really looking at? Well, we're really looking at that whole entire metaverse idea. And that will inevitably need to have essentially known figures, already established figures that people are interested in, IPs, right? So you're going to want to have your Halos, you're going to want to have your Master Chief, you're going to want to have your Nathan Drake from Uncharted, you're going to want to have your Lara Croft from Tomb Raider, you're going to want to have all of these iconic video game characters, name your favorite one, all in the same metaverse. That's really ultimately the goal, right? Just not dissimilar from that book and movie. What was it again? The virtual reality one. Why am I blanking on it? I just watched it recently. Maybe you guys can help me there. But the idea, like, it's a lot less cool if you don't have all of these iconic figures, right? Like all of the pop culture icons within that metaverse. If you don't have them, then you don't really want it. And I think initially with metaverse, what you will see is you will see like Metaverse A getting, you know, Super Mario and and all the Nintendo characters, right? And you'll see Metaverse B get all of the, you know, Sony PlayStation characters, right? And that will basically split communities. Whereas the real goal is to have all of it in one place, you know, Master Chief fighting Nathan Drake. That's what you, at the end of the day, that's the vision for your virtual reality world, right? Ready Player One. Yes, thank you. That is it. So really the ultimate, like if I look at a metaverse, right? First of all, I don't want web browser because I want to be able to utilize my full, and maybe web browser gaming gets to the point to where it can utilize my full PC. But I want, you know, good, high frame rate, high quality graphics with the characters that I am interested in playing in that metaverse. That's what I want. I want a Ready Player One universe to participate in. I don't want some knockoff weird BS like universe that doesn't have any of that. And that's going to be a problem, once again, like we were talking about with GameStop in particular, because the very industry that they're going to monetize with this, you know, NFT kind of push is the actual market that they have proverbially been, you know, f***ing over for quite some time. So it makes it very difficult for them to get those deals and partnerships. I mean, if you look at it, right, like there was even stuff in the movie for Ready Player One that they couldn't put in from the book because they just didn't have the licenses for it. And Ready Player One was already also one of the highest like costing movies from a licensing perspective as it sits. Maybe though, I mean, in reality, right, like NFTs do solve that problem to a certain extent because you can put those royalty fees into the actual smart contract, into the NFT. So that's where I would approach it from, right? I'd be like, look, this NFT, it comes from there. We can put it into any universe. You will always get that cut as a publisher or as a developer or whatever. You will always get that cut. And that NFT will track it across all of the metaverses. That's the ultimate goal, right? And it doesn't have to be within GameStop's marketplace specifically. And I think that's really where it ends up, what it really ends up boiling down to. How long does it take to get there is really the question, right? Of course, the ongoing macroeconomic environment punctuated by a Federal Reserve bent on hiking interest rates to curb an out-of-control inflationary impulse and a rapidly slowing down U.S. economy is not conducive for speculative plays. It is for this reason that growth-focused equities have been pummeled viciously over the past few months. The combined valuation of MetaMask and OpenSea roughly computes at $20 billion, based on the funding rounds that took place before the current crypto carnage accelerated. In today's environment, these enterprises would easily be worth around half of their previously lofty valuation. Let's be ultra conservative and assume that the two businesses combined are worth just $5 billion today. This means that GameStop's market capitalization should increase by at least $5 billion and compute at $13.94 billion, thereby corresponding to a stock price of $183 and entailing a gain of 56% relative to the company's current stock price. Do not take this as financial advice, guys. This is terrible. Of course, complicating this system or this simple analysis is the still fuzzy nature of GameStop's Web3 related ambitions, which continues to demand a hefty discount. Do not take that as financial advice and do not go out purchasing GameStonk. Please be very careful with that one. Ethereum's scaling solution, Immutable X, though, will allow Ether to dollar withdrawals. And this is where I say it gets important, because what is GameStop going to use? They're going to use Immutable X. What do people that are purchasing NFTs, especially purchasing and selling NFTs, want to be able to do? Well, they want to be able to eventually make a profit, probably at some point. There will be those buyers and sellers, you know, that want to sell their Master Chief from Halo, or want to sell their Nathan Drake from Uncharted, or whatever it may be, right? So they want to do those things, and being able to do that directly through a wallet or directly through an NFT marketplace is something that I would consider to be extremely relevant. And this does bode well for GameStop. Okay. The tool is one of the first layer 2 services to allow users to withdraw US dollars. Ethereum scaling solution Immutable X will allow users to receive US dollars in their bank accounts on Ether withdrawals, developers said this week. The Ether off-ramp is available to any developer building on Immutable. Developers can enable their users to sell the layer 2 based Ether and have the proceeds deposited directly to their bank accounts. Decentralized layer 2 solutions like Immutable X enable faster, cheaper, and more energy efficient transactions than the Ethereum mainnet. This would be extremely interesting too, because this would be a more decentralized way for miners to actually get their profit out. Unfortunately, it's on Ethereum. We don't know how long, we have to mine Ethereum. But when I see this, I go, hold on, I have a more decentralized way to get my Ethereum out. What? Okay. Granted, it's layer 2. It's not perfect, but it's much better than a layer 3 way, right? Like a crypto.com or a Coinbase. We're getting every day closer and closer to the actual principles of cryptocurrency, even as it relates to fiat. This is exciting news to me. As per developer documents, Immutable can process over 9,000 transactions per second, while the Ethereum network averages 10.54 transactions per second as of Thursday morning. This is one of the first instances of a layer 2 application allowing users to directly withdraw Ether holdings to US dollars. The fiat transactions are processed via crypto payments firm MoonPay. The withdrawal service is currently available only in European Union, the UK, and select US states. Immutable founder Robbie Ferguson told CoinDesk that the service comes at a time when the crypto community faces troubles from centralized crypto lenders. Boom. Yes, sir, that is true. Quote, centralized products failing over the past 6 months have made painstakingly clear that the importance of decentralized ownership, end quote, Ferguson said in a Twitter message. Now, anyone can take their ETH and receive USD in their bank accounts. Hell yeah. Withdrawals on popular but centralized crypto lending products such as Celsius remain paused as the crypto market saw contagion risk in June stemming from the collapse of Terra USD in mid-May and crypto fund 3 Arrows in June. And we have more of that coming too. At the end of the day, we are closer and closer to a layer 1 to fiat transaction. And I understand, look, there's probably going to be KYC here. Regardless, there will be some sort of KYC, because as soon as you put it into your bank account, they're going to be able to tie that bank account to the Ethereum wallet address. And that's not ideal. I get it. But like always, I like to point out that we are moving in the proper direction. What gets us moving in the proper direction every time too? And what is necessary? This is the thing that I think a lot of people miss within cryptocurrency. What is the catalyst to cryptocurrency moving back in the proper direction? It's the bear market. It's the crypto winter. It's the retail and institutional investors getting slaughtered because they don't understand the halving cycle and they don't understand cryptocurrency or what the basis is. This is almost necessary to push cryptocurrency within into the correct direction. Things like this are pushing it into the correct direction. Every day we get closer and closer. And it's pretty awesome. Argo blockchain hires derivative traders to navigate market route, sells Bitcoin to reduce loans. Yep, this is kind of what's happening across the board. It's just more and more. It always feels like the same article over and over again. Miner took out loans, can't afford loans, sells Bitcoin. That is pretty much it. But in the summary, let's go ahead and get the details. The miner saw gains in Bitcoin production in June, but its margins narrowed. Bitcoin miner Argo Blockchain said it hired an in-house derivatives trader to better navigate a market route that in June saw Bitcoin post its biggest monthly price drop in 11 years. The company also sold 637 Bitcoin at an average price of $24,500 to pay for operating costs and a loan from Galaxy Digital, it said in a statement on Thursday. Crypto miners have been selling Bitcoin as their revenues have slumped along with the bear market. The firm said that it had been using derivatives to limit downside risks since fourth quarter 2021 and hired a full-time trader to improve its, quote, capabilities within risk and treasury management, end quote. As of the end of June, London-listed Argo had $22 million outstanding with Galaxy Digital, according to the statement. The firm signed the $30 million loan collateralized by Bitcoin in December of 2021, according to its annual earnings report. Argo's margin narrowed to 50% in June from 55% in May and 75% in April. Driven by higher electricity costs at the Helios facility in Texas and the Bitcoin price drop, the miner revised its margin figure for May from 62% as it took into account newly received invoices. Last month, Argo's revenue rose 10% to 3.38 million euro, or is that pound? Anyways, that's in real dollars, 4.35 million US dollars. And I laugh really hard because it's not real. Don't worry about it. I'm just joking. As it produced 46% more Bitcoin than the previous month due to an increased hash rate and uptime. Argo is one of the 4 companies that have put down orders for new crypto mining chips from Intel. The others are Hive Blockchain, Grid Infrastructure, and Jack Dorsey's Block, formerly Square. Intel has shipped its block scale chips. Raja Koduri, Executive Vice President and General Manager of the Accelerated Computing Systems and Graphics at Intel, tweeted on June 29th. Argo shares were little changed in London as of 9:10 UTC. Bam, bam, bam. So, what are we learning? Well, we're learning that all of us could do this a little bit better and try to at least, DCA our way through the bull run and then make sure, and through obviously the bear market, but making sure you're selling off while the price is going up. And not getting stuck with, basically a huge drop in your capital to where you end up having to sell a bunch of your mined Bitcoin to pay off loans. Also, loans are bad. Even massive loans at a massive scale, for institutions still appear to be bad. And, we've talked about that before. Don't spend more than you're willing to lose, even on mining equipment, and don't take out loans. Pretty much it. Celsius pays off Maker loan, freeing up $440 million of collateral. So Celsius, as you guys know, has been in some trouble. The troubled crypto lender Celsius paid down the remaining $41 million of its debt to the decentralized lending protocol Maker, blockchain data shows, releasing $440 million of the collateral that had been kept to guarantee the loan. Celsius, the crypto lender that halted user withdrawals last month because of liquidity pressures, reclaimed $440 million of collateral on Thursday after fully paying off a loan on Maker, one of the largest DeFi protocols. On-chain data shows that the wallet linked to Celsius repaid the remaining $41.2 million of the loan in DAI, the Maker protocol stablecoin. That prompted the Maker protocol to release 21,962 wrapped Bitcoin, a Bitcoin equivalent token of Ethereum's blockchain, of the Ethereum's blockchain, which was pledged as collateral of the loan. That works out to about $448 million since wrapped Bitcoin is currently trading around 20,400. The move means a big liquidity boost for I can never pronounce this word, but crypto lenders' finances. Celsius halted all customer withdrawals and transactions on June 12th to avoid a run on deposits. FundStrat analyst Walter Tang told CoinDesk earlier this week that the collateral that Celsius freed up can be sold on centralized exchanges or via over-the-counter to meet creditor demands and customer withdrawals. CEL, the native token for Celsius platform, spiked 10% within minutes after the news, but it's still down 81% since the start of the year. Celsius slowly started to reduce its debt to Maker Protocol earlier this month, paying back $224 million altogether through the last 7 days. The loans on decentralized lending platforms such as Maker are generally over-collateralized, meaning that the borrower has to put up more assets in value as a backing of the loan than the value of the loan itself. Repaying the loan made sense for Celsius because it could get a grip of the valuable collateral by paying back a fraction of its value. And so will Celsius survive or will it not survive? I mean, they're obviously, because it's a centralized entity, I was kind of hoping it wouldn't to a certain extent, because obviously what happens is every time this sort of thing happens, it's not really about Celsius getting hurt as much as it is how much they hurt the individual in these situations. The individuals that were not controlling their keys, that were being, taking on these huge promises that Celsius was promising, right? These huge promises that they were promising. But you get the idea. Like, I don't think that I want to see us move back in the direction, like we talked about with the layer 2 withdrawals. I'd like to go more that direction. I'd like to see CFIs kind of not be a thing anymore personally. I would highly advise against participating within them, no matter how high that APR gets in the next bull run. And that is where I sit as far as all that goes. But the real question is DeFi already too centralized anyways? So we talk about CFI, we talk about DeFi, we talk about Celsius as an example of these. We talk about BlockFi, right, as an example of these kind of like centralized DeFi options. But is DeFi just itself too centralized? We have an opinion piece here. We're going to get into it. DeFi suffers from too much centralization. What can be done? If any part of their business model incorporates centralization, then it is centralized no matter what other decentralized feature it deploys. That is an interesting quote. That's very interesting to me, because if we look at some cryptocurrencies, right, or blockchains that really push decentralization and use that as a term to, market, essentially, to sell their given product to the masses. They're like, we're hardcore on decentralization, but we're going to take a 10% dev fee over here to pay our devs, right? We're going to take that over there. We're going to take this and put it into a foundation, and we're going to put it over here. We're going to control the changes that happen on the network. Just even from an actual blockchain perspective, there are a lot more coins out there that have centralized portions within them. And it's extremely important to pay attention to those and pick them out of the weeds. I see a lot of them, and a lot of them in places where, unfortunately, I think that it does deceive a lot of people from that perspective. And it's interesting to say, if any part of their business model incorporates centralization, then it is centralized no matter what what other decentralized feature it deploys. I like that quote. Quote, it's vital that people understand how the assets are pledging to a centralized entity are being used. Yep. And another quote, if users demand more decentralization with crypto lending, they simply have to vote with their funds by moving them. Yes, sir. Agreed. Like much of the crypto sector, decentralized finance is having a tough time. Not only has its total value locked in fallen by 70% since December, but various platforms within the not so decentralized DeFi space have been threatened with collapse, with Celsius halting of withdrawals being the latest and possibly the most dramatic manifestation of the ongoing crisis. While Celsius's inclusion within the DeFi subsector nominally makes it a decentralized platform, at least in the use of the blockchains, its control over user funds demonstrates that it was too centralized. Coupled with the collapse of Terra, which has been the second biggest DeFi platform, it has raised serious questions as to whether DeFi needs to become more fully decentralized and as to whether that or whether it can be. Opinion on this is mixed, with some industry figures affirming that centralization provides various benefits over truly decentralized platforms. At the same time, there seems to be an agreement that decentralization alone is hardly a guarantee against future collapses and crashes. Yeah, but the point of having it decentralized is that everybody's playing by the same rules, right? So when you have a centralization factor within DeFi, right? We talk about Celsius or whatever. We can use them as an example. Celsius themselves are not playing by the same rules as the rest of the fucking market, okay? And that is a big problem because now you have delegitimized the entire DeFi ecosystem because Celsius is not playing by the rules. They shut down, right? They shut it down to protect themselves as an entity, and they screw everybody else over that is playing by the rules. It is no different than traditional finance and fiat systems that everybody is so disgusted with that they want to use cryptocurrency to get out of, but now we're just seeing it within cryptocurrency. So anytime you add centralization, you add that factor of a group of people going ahead and not playing by the rules and manipulating it. Over-the-counter trades, for example, right? Figures within the industry are more or less in agreement that recent events involving Celsius and other platforms highlight the uncomfortable level of centralization within DeFi. Quote, recent events concerning Celsius, Three Arrows Capital, and Lido show that the lack of decentralization poses an issue to DeFi, end quote, said Tim Lays, co-founder of DeFi protocol Swarm. According to Lays, part of the issues in DeFi is that decentralization occurs on a sliding scale, with platforms being composed of a mix of decentralized and centralized elements. Quote, individuals and institutions can still benefit from the architecture and deployment of DeFi innovation, like self-custody and transparency, even if other parts of a service are somewhat centralized. However, the problem highlighted by recent events from major lending platforms is partly a centralization issue, but also transparency concern, including oversight of what happens inside a protocol, end quote, he told cryptonews.com. Exactly what I was saying, right? That just reiterates the problem. Looking specifically at Celsius, it too is a mix of decentralized and centralized elements. However, it's arguable that it was centralized precisely in the most sensitive areas. Quote, it utilizes the smart contracts and ledger infrastructure of DeFi, but customer funds get aggregated in custodial wallets, which are controlled by the company, end quote, said Ryan Shea, a crypto economist at trading platform Trax. And that's an extremely important thing to take into consideration, right? The worst part you could centralize, the absolute worst part is custody of the funds. That's the absolute worst part. So that's really where we're at with that. Give me 1 second, guys. We got wild Pokemon appearing everywhere. It just is what it is. It's summer. It's summer, boys. All right. So for Shea, decentralization and centralization is a binary issue, meaning that centralization is only one important area. In only one important area is enough to make a platform basically centralized. I agree. Quote, if any part of their business model incorporates centralization, such as aggregating customer funds into a custodial wallet controlled by the lending company, then it is centralized no matter what other decentralized features it deploys. That said, many other big name crypto lenders like BlockFi and Crypto.com also deploy centralizing structures such as hot wallets to conduct transactions, he told Crypto News. Have you guys noticed that, like, one of the things I like is that Crypto.com does not have me talk about their lending portions, their lending platform. And Crypto.com is great to liquidate your crypto assets and pay for your bills. That's what I use them for. That is their strong point. That is where they're suited. They also have your NFT stuff. They also have their lending stuff. From my perspective, as far as that goes, you want to stay away from centralized lending everywhere, right? Like that, just, you want to completely avoid it because you can't control those funds. Somebody else is controlling them. And that APY inevitably, and that return rate is inevitably going to change, right? Every time. And if it changes too much, if they're not controlling it properly, you're in a pickle. If a DeFi platform or company wants to be truly decentralized, it has to operate on a more or less fully peer-to-peer basis, with all transactions executed using smart contracts run on a distributed network of computers. Quote, good examples of such platforms, thank you, include Aave, which we've covered on the channel, Maker, and Compound. I haven't covered Maker or Compound, but we have covered Aave. You can go look those up. Unlike CeFi, centralized finance, users do not have to trust the lending company. Instead, they have to trust the integrity of the code that executes the smart contracts. Code is law. I wish it still was. Others agree with the view that if there's centralized control of user funds, then no DeFi platform is really decentralized, no matter what else it might operate on a distributed basis. Quote, this is the case with most DeFi platforms, which are decentralized only in name, but not in reality, such as Celsius. That's why we call them CeFi on this channel, right? Centralized for the centralized part. So, you know, centralized finance, which is funny because you would think like fiat, but yes, like we say CeFi is short for talking about any type of company like this, like BlockFi or whatever it may be. To avoid this problem going forward, the industry participants should focus on the push for deeper decentralization, which will, in turn, lead to a better overall product, end quote, said Dan Keller, co-founder of decentralized computational network Flux. It's interesting that Mr. Daniel Keller is talking about this because I do have, okay, it's fine. I'm still worried about that dev fund. Look, I get worried about dev funds. It is what it is. Of course, even with the decentralization of funds and transfers, centralization in other areas can still cause problems for DeFi platforms and crypto more generally. Quote, for example, if too many nodes in Lido are operated on AWS, which is Amazon Web Services, a cloud computing platform. We talk about them a lot on this channel. It makes the network more attackable, jeopardizing the goal of distributed network infrastructure and governance, said Timo Lays. Woo! Hey, Ethereum, moving to proof of stake. Read that. Lays argues that if DeFi wants to become more decentralized, compliance structures need to be introduced via a mixture of regulation and self-regulation. Quote, the entire end-to-end setup of node structures and smart contracts deployments should be auditable and clear to investors. That is not a problem specific to the current market turmoil, but something more fundamental in the infrastructure of DeFi, end quote, he said. The collapse of Celsius, which used users' funds to make investments on other platforms, highlights that an essential ingredient of decentralization should be transparency. Quote, it is vital that people understand how the assets they are pledging to a centralized entity are being used. The problem with committing assets to unregulated counterparties is the black box of rehypothecation and the lack of recourse should something go wrong. There you go. In traditional finance, deposit-taking institutions like banks have a set of rules governing how they can use client capital and are constantly monitored. Something like this will be needed for DeFi to be compelled to operate on a consistently decentralized basis. Yet Lays also says that platforms and users alike should push for more self-custody. Quote, the easiest way to prevent institutions from being creative with client funds is to keep custody of them. The architecture of DeFi enables you to retain full control over your assets. Add this to a regulatory layer and you have a winning combination, end quote, he said. Ryan Shea also affirms that users should push for more decentralization, including self-custody. Companies and crypto lenders are no different, primarily responding to customer demands because without customers, there is no company. There already exists numerous functioning DeFi lenders, so if users demand more decentralization with their crypto lending, they simply have to vote with their funds by moving them away from centralized lenders to decentralized lenders, end quote, he said. However, Shea also offers some warnings in relation to the push for more decentralization, suggesting that CeFi does have some benefits. All right, what are the benefits? Quote, first, CeFi lenders have historically tended to offer higher yields on their products than DeFi exchanges. I mean, hold your horses there. Hold your... Sure, they offer higher yields, but then you can't get the yield out and they just shut down your withdrawals. So is it really a higher yield? I'm just saying, is it really a higher yield at the end of the day? It's really just a no yield. You just lost your money. You threw it into a sinkhole is what you did. This ability to offer better returns has prompted speculation that they tend to invest in riskier products or enhance yield via rehypothecation, whereby collateral is lent out again to back another loan, generating additional interest payments, he said. On top of this, many DeFi platforms don't offer fiat on and off ramps, meaning that many mainstream users will continue to prefer the convenience of CeFi until today, and now we have it. Thank you, Immutable X. There you go. So that's going to be coming. Don't worry about it. We got it. It's coming, boys. It's coming. We're moving in the right direction. Quote, government regulation is being increasingly applied to crypto transactions, and the primary target is the on and off ramp. Indeed, it is the only viable target for governments to apply regulations such as KYC and AML, anti-money laundering rules, because they can threaten exclusion from traditional finance services for non-compliant crypto companies, he said. Don't worry, this resolves itself and there's really nothing they can do at the end of the day. Just saying. There's also the argument that decentralization on its own won't cause a significant reduction in the kinds of collapses the market has witnessed in recent weeks. What really matters is the quality of the team behind the project. That said, the same is also true for DeFi lenders. Is the team of sufficient quality to ensure that software bugs and or the design of the smart contracts are robust enough to withstand dramatic market events, said Shea. Ultimately, it's arguable that only regulation and transparency can ensure a substantial decline in risk when it comes to DeFi, regardless of how centralized or not a platform is. As Timo Lays concludes, regulation offers layers of transparency to existing products and innovation. In the future, investors should be advised to only engage with DeFi products where process and smart contracts are fully auditable. There is a path for recourse in the event of malpractice, and they have full transparency over how collateral is being used. Or just control your own wallets and only participate in DeFi. Sure, your on-ramp and off-ramp's a little bit difficult, but everybody has Cash App and can buy Bitcoin at this time, so you know what? It is what it is. Get to work. I'm pretty sure you can figure it out without the need for all of this craziness, okay? All right, so Ethereum testnet merge mostly successful. Hiccups will not delay the merge, is what we're hearing. This is the second testnet merge. Is Sepolia. Merge trials on testnets are essential to allow Ethereum developers and independent project developers to understand what they can expect when the actual merge takes place. Ethereum has now completed its second to last major merge trial on the public test network Sepolia, paving the way for its transition to proof-of-stake consensus mechanism. While it's been judged mostly a success, it was not incident-free. The final trial of the merge is set to occur on the Goerli network over the next few weeks before the official merge on Ethereum mainnet can be given the go-ahead. Ethereum educator Anthony Sassano, who hosted the Sepolia merge livestream on YouTube on Wednesday, confirmed on Twitter that the merge transition went through successfully, and he added that the testnet will be monitored over the next few days. Terrence Tsao, an Ethereum protocol developer, also said the merge transition itself had been a success, but noted around 25 to 30% of validators went offline after the merge due to wrong configs. However, he added that hiccups will not delay the merge. Superfizz, a founding member of the ETH staker community, cautioned during the stream, however, that the actual success of the merge won't be known for several hours or even until tomorrow. The final trial will occur on the Goerli test network. Superfizz added that the timing of the merge will depend on the reviews of the Sepolia test. The testnet merges are a form of dress rehearsal that is essential to allow Ethereum developers and independent project developers to understand what they can expect when the actual merge takes place. During the live stream, Ethereum co-founder Vitalik Buterin admitted that one of the challenges facing the main network merge will include much more third-party infrastructure that isn't present on the testnets. It's gonna come crashing down. You can't even get, like, look, I'm sorry. You can't, like, this is extremely difficult. But if you look at this, I'm just thinking about this from, like, a logistics standpoint. Like, 25 to 30% of the validators went offline after the merge due to wrong configs. How many of these third-party tools are just going to completely take a dump? It's just going to be absolute insanity, boys. Like, so much stuff on the Ethereum mainnet is not going to work. So many sidechains are not going to work. Get ready to trade on anything else and buy your NFTs somewhere else for the day, for the month, for the year after this takes place. Because if you can't get 30% of your validators to actually get online, what makes you think that, like, that's going to be any better when you're dealing with, you know, potentially, like, you know, like 100 times or more the amount of people that have to work on this transition for the mainnet. Whew, during the yeah, so there might be non-critical issues like that will just pop up in the merge that we're not catching with these tests. There's a lot of peripherals that are just not getting tested, and that's unavoidable and probably fine. It's probably fine. Don't worry about it. It's probably fine. Don't worry about it, boys. It's probably fine. Despite the news, Santiment has warned of a potential Ether sell-off, with the total ETH supply on exchanges reaching a new high of 13.8% on Monday, the highest since January 3rd, 2022. As of Thursday, percentage has declined slightly, with around 13.25% of the total ETH supply sitting on exchanges. The price of Ether is currently at $11.86. Actually, I believe it's higher. We're at $12.20 right now. So the news is getting out, and, you know, people are excited about proof of stake for Ethereum. So I think we had a nice little pump. I'm taking them mining profits and selling them for something else. That's what I'm doing. That's me, not financial advice. Let's run one more ad and then get into mining profitability for the day. Today's sponsor is Crypto.com. Crypto.com is my go-to centralized exchange for liquidating my crypto assets. With their Crypto.com Visa debit card, I can load up my mined Ethereum to pay for power and other operating costs quickly while earning up to 8% cash back. In addition to the Visa debit card, there are additional fiat options, including wire transfers, to easily receive your profits. Crypto.com also offers additional services, including trading and even staking, to earn additional revenue on your investments. Join 10 million plus users buying and selling 100 plus cryptocurrencies at true cost by using my affiliate link in the description for a $25 funding bonus. Or enter referral code SOAT at sign up for the same bonus. Remember, cryptocurrency investment comes with significant risks, so do your own research. I still can't get over this. So if you guys don't know my background, I was a cloud solutions specialist for basically what that meant is that I migrated on-premises infrastructure to the cloud. Okay. So I view things like the this current merge, right? Let's just take something simple. Okay, this is great. Let's take a migration for email from on-premises infrastructure, like an on-premises exchange server, right? And we're moving that to the cloud. So if you aren't aware, a lot of times when you're doing that, you'll go into a hybrid format or whatever. But just to make it simplify it, let's just say I'm running the tests and moving users over, and I do a test move, right? And let's say my test move reveals that there is 30% of the emails won't migrate due to some sort of bug or issue within that user's either account or configuration, right? This happens a lot of the time. If I were to just go ahead and complete that migration with 30% of those emails not moving over and bombing out, I would get fired, okay? When we talk about that large of a margin of like basically your infrastructure not getting moved over, I see a problem there. And so it's very weird to just hear like, well, that's not a problem. And like, this isn't even a dig on proof of stake. This is just like, I don't understand. Like, I get it. Like, that's just nodes. I guess from that perspective, you're still going to be confirming all the transactions, all that's going to be happening. But it sounds like potentially 30% of the infrastructure is just going to take a dump right away for Ethereum, right? That's what it sounds like to me. Anyways, mining profitability, not that great. Going on today. So for the 6th, we did 0.064, actually not bad. So we did $78 on about an average of 4 gigahash for the past 24 hours. Okay. Obviously I do better, more hash rate at night than I do during the day. It's really hot in Texas. That is really what's going on here. I'm rebuilding some infrastructure, trying to get through to it, but $78 there. That does mean that we did break $100 a day on the farm because we did 3,092 netta on our one miner. We have 3090s over there just because they run so good on it. And that equated to 2119. So we essentially had, almost $100 a day, like a $99 day, which is pretty good because, prior to the reset of the difficulty bomb, we were really having some pretty rough days around $75. We had a few good days on ERG Netta, but that's pretty much where we're at. Why am I staying on Netta like in ERG for my 3090s? Because they hash fully on ERG because it doesn't use as much heat and as much power. So I can run them and they run at the same speed the whole time. And the 3090s on ETH are just like a nightmare. I might as well just turn them off during the day. Probably even during the night on a couple of them, to be frank. So that's why I'm just going to keep them on ERG, stacking that netta. If you guys are curious though, how much netta is left in the phase 2 contract for GetBlock, there's 2,148,077 ERG left. So over halfway done. They started at 5 million for this one. So if you want in, you got to get in and get your netta now. Once again, one of the points that I wanted to bring up there is like, if you can hold the netta until it finds price discovery with the netta on the ERG blockchain, you're talking about a 3x increase in your return. That's something to consider. Not financial advice. It could completely bomb out and go to zero. Sure. Right. But if we look at the price of CNetta on Cardano and we look at the price of netta, there's a 3 times difference between those two. So I'm going to be trying to hold on to as much of it as I can personally. Let's get into what to mine in the RTX 3090 with corrected ZIL hash at 110 hash, corrected Kapow at 60, ProgPow at 60, and Firo proof of work at 60 at 10 cents a kilowatt hour. Xano is in first place at $2.28 in revenue and $1.49 a day after power. Ethereum is at $2.15 a day in revenue and $1.38 a day after power. Ravencoin is at $2.11 a day in revenue and $1.32 after power. Cero at $2 a day and $1.21 a day after power. Conflex at $1.81 a day in revenue and $1.02 a day after power. Firo $1.75 a day in revenue and $1 after power. Bitcoin Z $1.48 a day in revenue and 79 cents a day after power. And Flux $1.45 a day in revenue and 76 cents a day after power. Still more profitable if you mine ZEL hash on NiceHash, where it gets $1.56 a day in revenue and 87 cents a day after power. Ethereum Classic $1.43 a day in revenue and 66 cents a day after power. Ergo $1.39 a day in revenue and 76 cents a day after power. And that is pretty much where we're going to end it as far as profitability goes on that. Mining pools, let's see, or mining hash rate, let's see what the hash rates are at. Down to 215 exahash a second on Bitcoin. which is kind of nice because it's corresponding to an increase in the price, almost back over 21,000. Let's take a look at Ethereum. Now, Ethereum is really interesting because we had that big dip off. Look at this huge dip off in difficulty, right? Right there. That was nice. We've been talking about that. The dip off in hash rate. We had some spike up. It's kind of interesting, that spike timing too, around July 4th. And then, what does that correspond with? Bitmain, I'm looking at you. Are you testing those refurbished machines you're trying to sell to us? You bastards. All right. Ethereum Classic, 23.47 terahash a second. Let's take a look at Ravencoin. We are at 2.28 terahash a second. Let's take a look at Flux. Gotta love the Flux at 1.21 megasolutions a second. It is up about 0.05 megasolutions, 0.06 megasolutions a second since yesterday. Let's take a look at Ergo. Ergo difficulty is dropping even further, and the hash rate is at around 12 terahash a second. We'll see if that starts to pump back up. I'm thinking about moving maybe a couple more rigs over there. Who knows? Who knows? I got one rig over there at 2 gigahash just pumping out $20 a day. If we did 4 gigahash, it'd be 40. We could 6x that. That'd be $120. I should not be talking out loud about that right now. So I can 6x it with the current hash rate that's on Ethereum, which would give us $120 a day. And the difficulty is really nice and low. I'm going to think about it. I'm going to think about it. Mining pool profitability, last 90 days, Crazy Pool in first, Ether Mine in second, F2 Pool in third. Last 60 days, ZET in first, Crazy Pool in second, Ether Mine in third. Last 30 days, ZET in first, Crazy Pool in second, Ether Mine in third. Last 21 days, ZET in first, Crazy Pool in second, Ether Mine in third. Last 14 days, Crazy Pool in first, Mining Pool Hub in second, F2 Pool in third. Last 7 days, Crazy Pool in first, Nano Pool in second, F2 Pool in third. Last 3 days, Crazy Pool in first, F2 Pool in second, Hive On in third. And for the last day, Nano Pool in first, F2 Pool in second, and Flex Pool in third. Find me some more blocks, Crazy. You fell down for the day. All right. There you go. There you go. ASIC miner profitability. Antminer L7 still sitting in first place, around $20 US a day. KD6 dropping pretty significantly down to 16-17 a day, which means the KD5 is probably down too at 973, but it's at $9.99, $10 a day. But the HS3 used to be above the KD5, and Handshake's fallen down as well, down to $973. If we look at the S19 Pro, it's up. We are up on Bitcoin mining by $2 a day from yesterday at $5.75 a day if you were mining a Digibyte, though. So take a look at that option for your miners. I like me some Digibyte. Let's get into questions and answers. Remember, as always, super chats are never required, always appreciated, first to be read because they're the easiest to read. Super chat stickers help boost the algorithm the most. So if you want to help get the word out, apparently that's one way we can do it. But the best way you can do that is by clicking that little share button, sharing out to your friends, and clicking that like button as well. The other thing that helps a lot, of course, is going to be hitting that notification bell so you don't miss it when we go live every Monday through Friday, 9:45 a.m. Central to 10:45 a.m. Central Time. And as far as getting in contact with me and setting up a one-on-one meeting, we do that every week. I post my Calendly link in locals, and locals is going to be at sonofatech.locals.com. You can check out the pinned comment in the live chat. If you head on over there, you can become a member for free. Of course, the one-on-one meetings will be behind a $5 a month paywall, and that money is going to supporting the channel through the bear market, as well as, frankly, the mining farm to help cover it, because my goal is to basically not sell as much cryptocurrency as I can for the next 2 years. That is my personal goal. I'd like to hear your personal goals for your mining journey and what you are thinking as far as all of that goes. And then I will be covering more of my strategy later on. I have not finished my books yet for the monthly profits. Unfortunately, it gets a little complicated with Netta. So I'm not really sure how much I made, to be completely frank, because pulling the day and time and value of Netta at the given time, I need to figure out a better way to track that. It's really easy with Ethereum. It's a lot more difficult with Ergo and Netta. It just is. So I'm not really sure how I'm going to work out those budget sheets necessarily. I could just pull it out from everything that I pulled out, I suppose, at the time that I sold it to pay rent, etc. I'm not really sure. The other way that you can contact or get a question answered in the live chat here on YouTube is to tag at @SonOfATech. It highlights the message orange. Please do it at the beginning of the comment or the question so that I can see it. At the end, it kind of makes it a little difficult to read as well. We had a super chat from Chadwick's Racing. It says everything is fine. $10 super chat. Thank you, good sir, and puts the fire emojis. And Chadwick's Racing also with the super chat sticker, $1.99 super chat sticker saying, game over, man. Game over. Game over. Let me scroll up and get a little comments throughout the live stream. Jess says, Ask Son of a Tech, Bitrafil bill pay is now live. Nice. And then Harvey says, Ask Son of a Tech, their terms of service on CeFi lending makes sense that it's not your keys. You're lending your crypto for them to make loans. Essentially, you gave them to do whatever you want with it. Yeah, and you shouldn't do that. But there are DeFi ways of doing that with like Aave, right? Where you still control your keys. So there are decentralized ways to do that. Yes, there's going to be risk on both sides, but I'd rather take the risk closer to my principles surrounding cryptocurrency than take a risk that doesn't, isn't guided by those principles, right? That's where I sit as far as that argument goes. Linus says, Ask Son of a Tech, there's not 8% cash back anymore. You should change that. Yes, I need to change that. You are correct. I should do that. I need to update they were supposed to be giving me more assets, but then they had a huge shift there's supposed to be a whole bunch of new assets to use for the ad for crypto.com. And I was waiting on those, but to be frank, crypto.com is experiencing all the same struggles that the rest of the cryptocurrency market is. And I lost my original rep and I got a new rep, and then my new rep went on vacation, and then my new rep got COVID. So, they're on the struggle bus. Give them some leniency. I realize that, obviously there's a lot of stuff going on there. Detroit says, Ask Son of a Tech, better analogy. We're building a road. We're testing on a 25-mile-an-hour neighborhood to see how it works. 30% of the cars crash, but we'll still open the Autobahn. It's probably fine. There you go. It's probably fine. It's probably fine. That is a hilarious quote, man. Matthew Tong says, Ask Son of a Tech, true. I've done cloud transfers for mail too. Something as simple as auto forwarding configs had the employees panicking. Even just the little things. Yeah. Kojo says, Ask Son of a Tech, change pads on 3090 and they work. No, they don't, because you still don't have active cooling on the rear memory modules. AS says, at Son of a Tech, won't Babel fees mess with miner revenues emissions for Ergo, since there would be no need for Ergo? No, they will not, because as it's set up, there will be a liquidity type pool for those transfers, right? So basically, when you do the transfer and pay in a fee for of another token, that fee that you're paying still has to go in, and it converts it through Ergo. So you're still getting all the fees on the Ergo blockchain. That is how it functions. Also, thanks for the $1.99 super chat sticker. I prefer pie. Thank you, good sir. Oswin Raj says, at Son of a Tech, love from India. Awesome. Welcome to Texas. Coming to you live near Austin, Texas, from an undisclosed location. Kevin Smith says, at Son of a Tech, do you have an opinion on the DFI network? No, I have not heard of that one yet. It's really, really hard to do that. All right. So, don't forget too, guys, that we have a giveaway on sonofatech.locals.com for the Soulless Citadel NFT. Kevin Smith says, at Son of a Tech, by the way, I bought those calipers you suggested using your leak, and dude, you got swollen the past year. Yeah, I do jujitsu every day, no excuses. And I hit the weights every day. No excuses. 6 days a week, though, I should say. So lifting about 3 days a week and jiu-jitsu 6 days a week. No excuses. Happy Dictator says, Ask Tech 100% unlocked for the Ethos algorithm. Have you tested it? ETHOS algorithm? No, I have not tested it. For the Ergo algorithm. Have I tested? Yes. 100% for Ergo? Yeah, that's been around for a while. It works. It works pretty well, too. The 3070 Ti is a banger at Ergo. Miller Mining Company says, at Tech, do you think there will be enough price discovery of Ergo to support its reward reduction every 3 months? You know, originally I probably would have said no, but with the innovation that Ergo is providing to decentralized finance, specifically as it pertains to really like encouraging the miners to participate within it, maybe, right? Like, especially with the integration with Neta, which is integrated with Cardano, and Cardano wanting to utilize the Sigma protocols, you know, like, there's so much potential there, especially if, you know, all these other proof of stake networks keep effing up all their DeFi, right? AS says, Ask Simon Tech, doesn't Ergo have a timeline for dev fees? They have storage fees. A little different. I covered it before. I could probably cover it in detail again at some point. Detroit Iris says, Ask Son of a Tech, how's your jiu-jitsu going this week? No excuses. Oh, wait, injury. It's going good. I just got off antibiotics for the impetigo. Yesterday was the last day, so I'm starting probiotics here hopefully soon. Waiting on them to get here from Amazon. And then yesterday went really well. So even when I had the impetigo, I had to take 2 days off from jiu-jitsu. I still lifted, still worked out. AS says, Ask Son of a Tech, won't dev fees stop after some time for Ergo? The storage fees, I do not think the storage fees ever stop. I'd have to double check again. I need to re-up on that knowledge. Bernie says, Ask Son of a Tech, do you still own any SafeCoin? I've never owned SafeCoin. DP, Unique, which used to help run pools, etc. He was really big into SafeCoin. I think they sold it during the bull run and made a lot and kind of left it. Happy Dictator says, at Son of a Tech, how are your 5700s holding up? The XFX are holding up great. The ASRock and the MSIs are not holding up so great. Meaning they're just really, really hot. XFX and the Sapphires are banging though. They charge the wallet, and then my understanding is that they go to the network anyways. But there is an Ergo Foundation. And foundations always make me a little cautious. All right, boys, that's going to wrap it up for today. I'll answer this last one. I think Akuna Bataya says, "Ask Son of a Tech, I couldn't find your CPU spec mine coin in locals. Where is it hidden?" Probably early on now. I can go pin it and do an update for you guys, though. I'm working on some more updates for it. Happy Dictator says, "Ask Son of a Tech, should I build a 5700 rig for Ergo or a 3060 rig? They're about 300 to 350 around me right now. And I want to diversify from just Flux and ETH. I mean, if you want to diversify, the 3060 is really kind of probably the way to go. You know, their hash rate's not as high as a 5700. But you're going to have to put more work into the 5700 because you're going to need to flash the BIOS. R mode's very finicky. And it's, you know, it's an older GPU, so its resale is not as high. So that's kind of why I would lean towards the 3060. The ones I'm really eyeing now is probably the 3080s, though. Because the prices are coming down and people are ignoring them, it looks like, a lot more, at least in my area. Hit the like, comment, subscribe, notification bell down below so you're notified when we go live. Don't forget to share out the stream and also check out Locals and become a free member. We are almost halfway to the membership goal of 800 members, and it's free to be a member over there, so you can do that. There are specifically community or supporter only posts that are $5 and for a one-on-one meeting. Being a supporter is required. So you're basically paying $5 for the ability to meet with me for an hour a week, basically, at this point. So I think that that is fair enough. If you don't find that fair enough, let me know. We also do exclusive giveaways for that too. I'm trying to come up with more giveaways, more stuff to just increase the value for your money over there, in return for obviously supporting the channel, because I appreciate it and keeps me rocking and rolling through this bear market. It allows me to definitely do what I love, which is always appreciated. I feared, and I still always fear, that I might not make it through. But we keep doing it somehow. We keep doing it somehow. We keep making it. So I appreciate it. See you guys next Tuesday.